But we believe strongly in portfolio construction. I think that's the single most important thing you can do to determine outcome. And the people who do well over long periods of time are experts at it. And the people that fall short usually either bet the house on a deal that took up too much of the capital in a fund, or had excessive concentration risk in a product type or geography, or violated some other rule of diversification. And we've been very, very intentional. So when you do things in a fund structure, first of all, you have the inherent benefit of providing diversification to an investor that he simply or she doesn't get when they choose to do a one-off investment in this or that property. So when we build a fund, we can do 6, 8, 10, 12 properties in that fund. We can put them into 3, 4, 5 different geographical markets that will balance each other out. If something goes wrong in Phoenix, my properties in Seattle, Portland, and Denver are probably going to balance that out. Not to pick on Phoenix, just an example. If we have a portfolio of 10 multifamily properties, and some are 70s and 80s vintage, and some are 2000 and 2010 vintage, well, we've got some vintage diversification because we're probably not going to need to put new roofs on all 10 properties next Tuesday. So there's 100 things that you can do. We also put our debt on at the property level, not at the fund level, and there's no cross-collateralization, so one bad apple cannot sink the barrel. So we've created a bunch of rules, a bunch of safeguards and guardrails that we believe protect principal, provide that margin of safety, add diversification, and generate alpha in the sense that we learn things from this property that we can transplant over to that property. And we hope that by focusing on an asset class and focusing on half a dozen markets, which is what we do today, this can all be pretty accretive for our investors.